Good evening, everyone. This is Tom Marshall, Virginia State and Retirement Planning Advisors. This is our update as of Friday, May 8th. I'm recording this on Sunday night, May 10th. The futures markets have just opened up. They're going to be higher. Looks like we're going to have a good day on Monday, which is a good thing. This is a chart of the Dow Jones Industrial Average from January of 2018 through Friday. We are still down 9% over 27 months in the Dow Jones Industrial Average. This is January of 18 over here. This is the summer of 2018 right here. This is Christmas of 2018. This is 2019. And then here we have January and February of 2020. And then we had our first quarter problems. Fastest decline in the history of the stock market, and then the fastest rally back. Okay, so where does that give us then? So right now, you're going to see some new portfolio pieces added in next week. We're going to be going through that here shortly. But we're starting to see more institutions coming back into the market, which is a good thing. It shows we may have some legs, and perhaps we do not get a double dip as far as what people are worried about with the stock market, and that's a good thing. But we're also seeing some bifurcation in the stock market, which is actually quite troubling. So we've actually still made hardly any progress since 2018, and it's really combined or condensed. The gains have been really condensed into just to a few stocks. Let me show you that. This is a chart from February of 2019 through, January of 2019 through Friday. And so what we're seeing here is the blue line at the top. This is the value of, if you combine the FANG stocks, Facebook, Amazon, right up here, Facebook, Amazon, Apple, Microsoft, and Google. Since January of 2019, those five stocks together have gained 48.95%. That's quite a good thing, 48.95%. The S&P 500 since January of 2019 is essentially flat right there. I'm sorry, it's actually January 26th of 2018 up here. So yeah, so for the FANG stocks up 48.95. S&P 500 is essentially flat since that time frame. Now, what's interesting is the S&P 500, which is the black line. Now, if you take the S&P 500 and you take out Facebook, Amazon, Apple, Microsoft, and Google, just these five stocks, the other 495 stocks in the S&P 500 index are actually down 46%. So I want you to think about that for a minute. So right now, since January 26th of 2018, the S&P 500 by itself is about break even, up about 2%. If you just look at the five biggest stocks in the S&P 500, Facebook, Amazon, Apple, Microsoft, and Google, those five together are up 48.95. If you take this S&P 500 return and just subtract those five stocks and their return from the index, the remaining 495 stocks of the S&P 500 index are actually down almost 50% since that time. This is really unusual. This just speaks to people piling into the FANG stocks. This speaks to a very narrow market, and really it just speaks to the fact that only five stocks are really responsible from any of the gains that we have seen off of the lows since January, but also since what we saw in March of this year, a couple months ago. So everybody's piling into these FANG stocks. Without the FANG stocks, those five companies, the S&P 500, less Facebook, Amazon, Apple, Microsoft, and Google, would be down 46.1%. Very rare, and also has the models looking going, this is not what you should see. If this was a bottom that was sustainable in the stock market historically, the rising tide should lift all boats, and everything. This orange line should be way up here by now, and it's not. And it just shows you how tenuous we are in the stock market right now, because of what's going on and how few companies are participating to the upside. This is another chart from Y Charts, our friends at Lynn Alden, our friend Lynn Alden. She does a lot of decent work from the research side. This again is a different chart comparing from January of this year and comparing different ETFs. So again, just kind of showing you, purple is the triple Qs, which is the NASDAQ 100. The spiders here, the SPY is orange. Equal weight S&P 500. So regular S&P 500 is weighted by market capitalization, so that the largest companies account for the most of the gains. Equal weight takes advantage of the idea that smaller companies during a bottoming process in advance should lead off the bottom, because the small companies have better growth prospects. There's the 400, mid-cap 400, iShares Russell 2000. These are the small caps, and then that's another small cap, the S&P 600. So what you're seeing here right now is that the NASDAQ 100 is actually up 4% for the year. And again, this is primarily heavily weighted. Those 100 are primarily, over 50% of that index is Facebook, Amazon, Apple, Google, and Microsoft in there, because it's a smaller index than the S&P 500. The S&P 500 by itself is down 10% for the year. The equal weight S&P 500 is down 18, almost 19% for the year. So again, here is just showing us this line here. This is the S&P 500 with just the companies weighted according to their market capitalization. So the bigger companies account for more of the index the way it is supposed to be done. And then the blue line here is that same S&P 500, but each company accounts for an equal share of the gains. Ticker symbol is RSP, but it's an equal weight S&P 500, and during a normal time period, it does very well. The smaller companies typically grow quicker. The mid caps, S&P 400, the mid cap index is down 21%. The small caps year to date are down 22%. And the other small cap index is down 33%. So normally, and this is just kind of gives you an idea how this typically works, in a lasting bottom coming out of a correction or a recession, small caps, the smaller companies always lead. And this is very rare that the biggest companies, in fact, the biggest 5 companies, are really the only ones making much headway here. So again, something to be mindful of, but we are getting institutional buy-in, which is actually good. But we do have some valuation issue warnings. And so, as many of you have known or seen over the years, we like Warren Buffett a lot. We like some of his research. You'll probably notice that Warren Buffett did not buy anything in this market correction. He famously has gone on record in his most recent letter to shareholders saying they could not find anything of value to buy because values did not get cheap enough before the Fed intervened. In fact, they did. They were net sellers. They sold all of their airline stocks because he just doesn't believe in airlines will ever make it back, or at least not in the near future, make it back to something where they can make decent money because of this. But Warren Buffett famously referred to what's called the market cap to GDP ratio back in the 2000s, and that's what allowed him to call the 2000 correction. And the way this works is you look at the idea is behind this is how much am I paying for the stock market in relationship to the GDP of our country? And so what you do is you look at the Wilshire 500 index. It's a fraction. You got a numerator and denominator. You look at the Wilshire 5000 stock index. It's the numerator, and the denominator is the quarterly GDP. And so what we're trying to do is we're trying to figure out what percentage of the quarterly GDP does the stock market cost. Right now, the stock market after so this is January right here, had the correction. We barely went down here. And now here we are again in May of 2020, and the market cap to GDP ratio, as far as what we're paying for the stock market in relationship to the GDP, is 144%. We are now back above the level that we paid in 2000, before the dot-com crash. Historically, what happens before the cycle is over, the market cap to GDP ratio reverts back to right around 100% or lower. So the Federal Reserve intervened. That did not happen because of their intervention, so we have to keep that in mind. Is that the reason why? But again, what it's telling us here is that stocks are ridiculously expensive right now, given the GDP in our country and the valuations we're putting on the Wilshire 5000 as a whole. So unfortunately, what this is telling us is that we are still in nosebleed territories, and if we do have another correction, it's going to be swift and painful, because the highest valuation time periods in the stock market tend to have the deepest corrections. And here we are again at 144% market cap to GDP ratio, which is extremely high. Incidentally, down here at the bottom, this is actually the bottom in 2008 and 2009 after the great financial crisis. It was down here at 56.8%. Even before the great financial crisis in 2008, it was only 105%. So here, this is a serious nosebleed territory for the valuations that we're paying for these stocks right now. Something to be mindful of. Hopefully we go back to work quickly. So what typically should work now? And this is what you're going to, if some of you have already seen this in the portfolios, depending upon whether your account is at Folio, TD Ameritrade, or Charles Schwab. But typically what happens is gold does extremely well coming out of these time periods once we get kind of a more all clear, because when the Federal Reserve resorts to printing money. Now remember, the Federal Reserve, let's just take a step back, because that's a little bit of a misnomer here. Let's talk about the Treasury. So right now, well, before this all started, in January of 2000, our country had $17 trillion of national debt that was sold to other countries. Does not include other unsecured debt or Medicare and Social Security, but we had $17 trillion of debt that we had to pay back. We now, as of Friday, have $26 trillion of debt. So in the factor of about 3 months, we added close to 50% to our debt of our country. So essentially when that happens, it means the value of our dollar should go down, because it's no different than turning on the printing press. There's no real value that backs the US dollar other than the good faith of our country. And so what's happened is we are printing dollars and there's no assets to bring it back or back it up. And what you typically see happen during this time period is people are going to gravitate towards assets that the central banks can't manipulate. So we know that central banks have manipulated before in the past, at least their currencies. And so the other currency that's out there that cannot be made or manipulated by central banks is gold. And so what you typically see coming out of these things is that people, or what does best, is gold, because there's only so much gold. It is a currency proxy, and federal governments cannot print more of it. So this is a chart showing the relationship of U.S. unemployment to gold. This goes back to 1960 through a week or two ago. And what you typically see in this cycle, the black line is the gold spot price 5-year rate of change, and the red is the unemployment rate 10-year rate of change. And what you see is that after the unemployment rate bottoms, You see it bottoms in different places, and you have a major cycle bottom. What happens then is that gold typically takes off for an extended period of time. And so we are likely to see for the next 2 to 3 years is that the best performing asset is going to be gold and the gold mining companies and indexes and mutual funds. You're going to be seeing more of those get put into the portfolios as we go forward. But right now, we're having serious discussions on what else we add because these actually could do better than anything else, any other sector that's out there right now. I'll give you an example. In 2008, when we had our problems at the Great Financial Crisis, after we bottomed in 2009, the best performing sector was gold and gold miners, or gold miners in particular. The gold mining index almost tripled in 3 years, 2.5 years. And so that's because the Federal Reserve in 2008 started printing money, and now they are printing more money than we would ever know what to do with here. So, well, we know what to do with, but they're printing money with no assets behind it. And so people are going to drift back to other assets that can't be manipulated. And since interest rates are almost zero, we're going to see that as well. There's no reason to hold U.S. Treasuries if interest rates keep going down. So gold should do fantastically well over the next 2 or 3 years historically, just given what's going on and what's driving this. And you're going to see more gold and gold mining pieces get entered into the portfolio. We're also going to see more than likely the alpha-centric bond fund come back into the portfolio. We're not quite there yet. As you may remember, this is the one that had all the problems because of the liquidity issues in the bond market and everything else that was going on out there. The bond market locked up, and then there was the moratorium on rent and that sort of a thing. But it looks like if we can just get another month's data in from the portfolio managers, it looks like we're still near where the price we sold it at, but it looks like people are still paying their mortgages and the valuations are still where they need to be. So we'll get close to a 7% yield on that fund if we buy it back where we sold it we sold it back where it is right now. And then we're actually buying those mortgages right now at about 50 cents on the dollar. So we'll be in good shape on that. But you'll see some more things going in there. And then some things from before. But just a quick update of what we're seeing. We're going to see more pieces go back into the markets now based off of what is happening. But we have to be mindful of other sectors participating, not just the FANG stocks. Because again, the one that's most troubling to me is that this one, the five FANG stock: Facebook, Apple, Amazon, Google, and Microsoft, up 40, 48, 49% since January of 18. But the other 495 S&P 500 companies are down 46%. That is just crazy to me. So I think this is just going to be an unusual time period going forward, and that's where you're going to see more gold and other things, the more unusual pieces going in there. So again, if you have any questions, let me know. The models are starting to turn more positive, and you're going to see more things enter the portfolios as we go forward. And don't hesitate to reach out as we go forward. All righty. Have a great day. Take care.
With none other JJ being the head lead instructor in our room. The room is going to officially open on August 26th, 9 a.m. Eastern Time.